Welcome to our comprehensive guide on stock markets and trading. In this video, we'll explore what trading means, how stock exchanges work, their fascinating history, including India's role in this journey, and the factors that make stock prices rise and fall every single day. Let's dive in. So, what exactly is trading in the stock market? At its core, stock trading is the buying and selling of ownership shares in companies. When you buy a stock, you own a small piece of that company. Stock exchanges are the marketplaces where these trades happen. Think of it this way: a company needs capital to grow. Instead of borrowing from a bank, they can offer shares of their business to the public. This is called going public. Now, when you buy those shares, you become a partial owner and have the right to any profits the company makes. Trading happens through stock exchanges, formal marketplaces where buyers and sellers come together to negotiate prices. The price of a stock is determined by simple supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell, the price goes down. It's that fundamental balance that drives the entire market. The stock market didn't start yesterday. It has a rich history spanning over 400 years. In the 1500s and 1600s, early trading of commodities and bonds emerged in European cities, like Antwerp and London. But the birth of modern stock market happened in 1602 in Amsterdam. The Dutch East India Company created the Amsterdam Stock Exchange, making history as the first publicly traded company. Here's why this was revolutionary. The Dutch East India Company needed massive capital for their global trading expeditions. Rather than using a single investor, like the king, they issued shares to many investors. This spread the risk and allowed the common person to invest in large ventures for the first time in history. In the 1600s and 1700s, stock exchanges spread across Europe. The London Stock Exchange was formally established in 1773, initially meeting in coffee houses where traditional brokers and merchants gathered to trade shares and bonds. The story crosses the Atlantic to America in the late 1700s. On May 17, 1792, 24 stockbrokers and merchants gathered under a Buttonwood tree on Wall Street in New York City. They signed what became known as the Buttonwood Agreement, essentially the contract that established formal rules for stock trading in America. They committed to buying and selling securities among themselves and not conducting business with non members, thus making it an exclusive elite group. This wasn't a fancy building, it was under a tree. But this simple agreement eventually evolved into what we know today as the New York Stock Exchange, the world's largest stock exchange. In 1817, these traders created a proper exchange called the New York Stock and Exchange Board. Members had to pay fees and follow a dress code. The exchange initially traded just government bonds and bank stocks, but eventually expanded to thousands of companies. Over the 19th and 20th centuries, technology transformed everything. The telegraph allowed traders to communicate across distances. The telephone eliminated the need for in person meetings, and eventually, computers revolutionized the entire system. Now, here's something fascinating. India has one of the oldest and most vibrant stock markets in the world. The Indian stock market story begins in 1830s, Bombay, when a small group of brokers started trading securities of the East India Company under a banyan tree near the town hall in Mumbai. Yes, Just like the Buttonwood tree in America, India's first stock market traders met under a tree. By 1875, these brokers formally organized into what was called the Native Share and Stockbrokers Association, the predecessor of today's Bombay Stock Exchange or BSE. They moved to Dalal Street, which means Brokers Street in Hindi, and that location became the heart of India's finance. Today, Dalal Street is synonymous with the Indian stock market, just like Wall Street is synonymous with American finance. The BSE became Asia's oldest stock exchange and remained India's only national exchange for nearly a century. However, in 1992, the government established the National Stock Exchange (NSE) to modernize India's financial markets. NSE launched in 1994 with fully electronic screen based trading, a revolutionary step that transformed India's markets overnight. Within just 1 year of its launch, the NSE's daily trading volume exceeded the BSE's. Today, India has two major exchanges, the Bombay Stock Exchange and the National Stock Exchange. Before computers and the internet, how did stock trading actually work? In traditional floor trading, brokers gathered on the stock exchange floor, a physical location buzzing with energy and activity. Traders wore brightly colored jackets to identify which firm they represented. They used an open outcry system, shouting and using hand gestures to communicate buy and sell orders. Imagine the chaos. Hundreds of traders on a trading floor, all shouting simultaneously, gesturing frantically to indicate how many shares they wanted to buy or sell and at what price. It was intense, noisy, and required tremendous skill to remember all the trades happening around you. Orders came from client brokerages via telephone. Clerks would receive the order and relay it through hand signals to their traders on the floor. Once a trade was agreed upon, it was manually recorded on paper. Settlement, the actual transfer of money and shares, that is, could take days. This system worked for centuries, but it had serious limitations. It was slow, it was inefficient, it was prone to human error, and it could only handle a limited number of transactions per day. By the 1970s, technology was starting to make the system obsolete. In the 1970s and 1980s, everything changed. Nasdaq became the world's first electronic stock market in 1971, completely revolutionizing how stocks were traded. Instead of traders shouting on a floor, electronic systems matched buy and sell orders automatically. Computers became the middlemen, and speed increased dramatically. What once took minutes could now happen in seconds. In India, this transformation came with the launch of National Stock Exchange in 1994. The NSE was India's first fully electronic screen-based trading system, while the Bombay Stock Exchange still had a physical trading floor. The National Stock Exchange showed the future was digital. Within years, the BSE also upgraded to electronic trading. The digital revolution democratized Indian stock markets. Suddenly, retail investors could trade stocks from anywhere, not just from Dalal Street. Today, trading is almost instantaneous. When you place an order through your smartphone or computer, here's what happens behind the scenes. Your brokerage receives your order and sends it to the stock exchange's computer system. This system simultaneously checks all other brokerage systems to find the best price available. Once a match is found, the trade executes in milliseconds. Your account is updated in real time, and regulatory agencies like SEBI, Securities and Exchange Board of India, are notified automatically. The entire infrastructure is incredibly sophisticated. Computerized matching engines process millions of trades every minute. Backup systems ensure the market never goes down. Blockchain and encrypted security protects your data. All transaction records are permanently stored and auditable. The result? Retail investors like you and me now have access to the same tools and speeds that were once exclusive to Wall Street. We can trade from our phones anytime, anywhere.